India is a country, now new billion is a trillion. Think about that. Have that ambition to become a trillionaire, not a billionaire. I think the sad thing is that people come to the stock market not to make money, not to double money in 5 years. They want to double money much faster. And that's why where you can make a patient 14-15% or maybe even 17-18%. People want to make very quickly, and that's why they get into speculation. There are only two things in the stock market: price and value. Everybody knows price, nobody knows value. Okay, so since the price is fluctuating, they think that I can buy at 100 and sell it very quickly, sell it for 105 and take my... He doesn't realize instead of going to 105, if that goes to 95, what to do. And more often, in fact, out of 100 times, if 51 times you lose and 49 times you gain, still you lose. The best thing about the market is there are 4,000 companies, you need to know your 10 companies. And rest all 3,990, let Raamdeo make money, let somebody else make money. You are making money in 10 spots. That's it. I mean, if I've enjoyed every moment of it, so I have not committed any major mistake, but we can always do things like what happened was in 2003, I listened to somebody and I stopped investing for 10 years.
Oh my God. Hey everyone, this is the India Story podcast. I'm Vikram Chandra and I have with me Raamdeo Agrawal, the chairman of Motilal Oswal Financial Services. When we talk about writing the India story, you, Raamdeo Bhai, are the person who really understands the story of the Indian stock market, the past, the present, and the future. And over the course of the next 40 minutes or so, I'm going to get you to describe all three.
Sure, we'll try our best, but thanks for coming.
It's always a pleasure to be here with you. So, past or present ka baad mein baat karte hain. First, I'm very interested in the future because some of the statements you've made have got a lot of people very interested. You said, bhai, Sensex ka 85,000 hai. It'll be 100,000, 101.5 lakhs ke kareeb hoga by 2030. Sensex will be 3 lakh by 2035. Sort of forecast you stick to.
Yeah, of course. I mean, see, it's simple extrapolation of whatever has happened. I don't have any extra technology or insights or anything like that. I'm in the market for last 45 years. I bought stocks when Sensex was 100, which is now 82,000. So it has grown at about 16%. I'm not saying 16%. You grow at 15%, in next 5 years, you'll be double. So basically, when you say 1,50,000, the gap is like 85,000, 75,000. But actually, I'm saying double. 70, actually, I'm not saying 1,60,000. I'm saying only 1,50,000. So it is less than double in 5 years.
Actually, it will be interesting. I have maths kiya tha ki to achieve your target, Sensex 3 lakh by 2035 sounds impossible. But if you look at it in terms of IRR, it comes to about 13.57%.
13-14%,
13.57%.
And even if it gives you 12 or it gives you 16, so 16, of course, I'm more than right. But even if it gives you 12 and you reach, instead of 3 lakh, you reach, say, 2,70,000, 2,50,000, how does it matter?
It's still a lot of money to be made. 12%, 13%, because when you are compounding it, that's where the real magic happens.
So there are very few stories like this at a country level. So then comes investing, when you look at the countrywide opportunity, from where you come and which country where I can bet on. So there is one US, which has the story like this, compounded story like this. One is India. There are hardly any country, whether the demographics is going away, whether they don't believe in capitalism. Say like China's story is even bigger than India's story. But they don't believe in capitalism. They have common prosperity program. They have a whole lot of things where they cut the prosperity of the entrepreneurs. And that doesn't fit into their scheme of things. So actually, we are clear case. Despite our little bent on socialism, we have prevailed on the market economy. And that is... the stock markets are the epitome of market economy.
So, the story that you're talking about, that here is an economy that is growing at, the stock market is going to go at 13 to 14%. And this is a siren call that is in many ways, there seems to be a revolution happening all around us. A large number of Indians and retail investors, people watching this. I know that a podcast with you, a lot of people would be interested in, because Indians have become very interested in this entire story. They see this as an opportunity to become rich.
Yes.
stock market is not a gambling anymore, right? There used to be a time when people said, Satta Bazaar, aap khel rahe ho. But now, and I think it's important for people to understand this, if you're doing it for the long term, you know what you're doing, you can make a lot of money with that sort of return.
Yes, but I think the sad thing is that people come to the stock market not to make money, not to double money in 5 years. They want to double money much faster. And that's why where you can make a patient 14-15% or maybe even 17-18, people want to make very quickly, and that's why they get into speculation. I hope people do speculate knowing that they're speculating. It's a very high risk game, very, very high risk game. The problem is that the speculation and investing both are merged at the same quotation. It's the same market. It's if you take delivery, you stay invested, you are investor. And if you do buy, sell every minute, every half an hour, you are in a speculation. So it is very difficult to figure out who is doing wrong, who is doing right. But there's not so much of money for retail in speculation, though they want to make it faster. But there is tons and tons of money on the investing side.
I was talking, in fact, to Nilesh just a short while back, and he was saying something similar. He said that it's very easy to make money through investing. It's very difficult to make money through trading. The chances that you will lose money are a lot. Retail investors who are speculating, who are doing options and trading, I think the last data that I saw, 90% of them lose money. So if you're saying buying, selling, quick buck, you lose money. If you're saying I'm going to buy something or buy a good mutual fund, sit in it for 5 years or 10 years, you'll make money. Is that a reasonable way to put it for retail investors?
Yeah. So what about, it's everything is probabilistic in this world. Nothing is sure. So if you are investing, 98-99% chance you'll make good money, that 13-14-15%. There could be still some guys who might have bad experience. But in speculation, 98% will have bad experience. 1 or 2% will have good experience. Now those masters of trading, they would know they are very good at it. For whatever reason, God has given them, or they have the kind of aptitude, or the way they do it. They understand the prices or intensity they bring. So they would know the person who is good in trading, he doesn't have to go away from that. He must do it because he has mastered that skill, that he can make money, he can make fool of everybody and make money. But there are very few. So if you are trading, say you start trading, and you lose money, don't even try again. Lose 1 lakh, 2 lakh, 5 lakh, 10 lakh, whatever purpose, and then forget for the whole life. Come back to the investing. There's a lot of money out there, but it will be a slow, patient return.
The word you use, make fool of them, that actually may well be very true, because as what we are hearing now is, when it comes to the trading, when it comes to the speculation, when it comes to the Satta Bazaar sort of a thing, that is where there's also manipulation. And we are hearing it now increasingly, Jane Street and all there's talk about, is there manipulation happening? And so it's tough in any case, and now also the scales are weighted against you.
Yeah, it is very difficult to say what is manipulation and what is speculation, whether dirty, clean. We are talking 400 lakh crores in a day trading. It's an ocean, it's a mountain. So in that kind of situation, you are a small fry. You are doing one contract here, one contract there. It's not about manipulation. It is about you are up against a lot of adversities. Nothing is working for you. It's only the price. Value is not. See, fundamentally, Vikram, what is stock market? There are only two things in stock market: price and value. Everybody knows price. Nobody knows value. Okay, so since the price is fluctuating, they think that I can buy at 100 and sell it very quickly, sell at 105 and take my. He doesn't realize instead of going to 105, if that goes to 95, what to do. And more often, in fact, out of 100 times, if 51 times you lose and 49 times you gain, still you lose. So how do you beat those odds? The guys who are 55 times right out of 100, they win big time. But 45 times you have to lose in the process.
They win big time provided they hold on to it long enough.
I don't know. I have never traded in life, so I have no advice to the traders. I only say if you keep making money, you are good in that profession, please do it, because there is no faster money than trading.
So let's agree on this thing that most of the people watching this should try and be careful about trading. What do you mean by trading? You mean कि भाई आज खरीदेंगे कल बेचेंगे मुझे टिप दे दो मैं ये करता हूँ वो करता हूँ उसने ये कहा था वो ब्रोकर ये कह रहा है मुझे किसी ने व्हाट्सएप पे कुछ भेजा है. That's trading. I'm going to buy today. I'm going to sell tomorrow, making a quick buck.
Yeah.
It's almost like betting. It's almost like gambling.
Yeah.
There's no science behind it. Or there could be some science behind it, but unless you really know what you're doing, the chances are you could get your fingers burned.
Yes.
If Raamdeo Agrawal says, I'm not sure I can make money in trading.
No, I cannot make money. I'm saying firmly, I cannot make money. Period.
So if you're saying you can't make money in trading, then the average person watching this should not try it. अब अगर आपको invest करना है, so you're not doing trading now. Let's all start with that as one. Now you are investing for the long term. What you are essentially doing is, when you are investing in buying shares of a company, you are essentially betting on a long-term, the India story, the growth of the Indian economy, the growth of corporate profitability, and yes, will I be part of that or not? Is that a right way of summing it up?
Yeah, of course, the external environment is very important. But I think what the enterprise is going to do, see, ultimately the businessman and the business, I mean, we were nobody, say 40, 50 years back, and we have brought this company this far. So, yes, it is an enabling environment of country growth and opportunity in the financial sector. Yes, that has come with the company. But to make it happen, it has to be the entrepreneur and the enterprise. You have to start a company with a right set of people, and the entrepreneur has to die to build that company. So where are those kind of good business? See, fundamentally, there are two types of business: good business, bad business. Good management, bad management. This you have to figure out where is a good business and where is a good management. Once this combination is done, your 90% research is done. 10% is you should not buy overpriced.
So I'm going to come to you. You have a very interesting framework that I want you to talk to people about. It's called QGLP, a formula. I'll come to that. What you're saying, though, about finding the right company is for those people who are watching this who might say, "Hey, I want to do direct stock picking. I want to go and find companies. I want to be the stock picker." Why should you be a stock picker? It's because you think you can do better than the average. A person who is not really interested in it or into it or have much knowledge and is doing it at a more passive level, what you are saying about finding the right company is not important if that person is just buying a mutual fund or buying an index, because then you're betting on Sensex mein kya hoga, Nifty mein kya hoga. Correct?
Yeah, that's it. So when we started our career in 87 and all, these pooled mutual funds were not there. This concept of mutual fund was not there. It all came turn of the century, I mean, they got licenses sometime in 94, 95, but actually it started becoming popular sometime in 2003, 4, 5.
Master share hota
tha. That was all 92 unit trusts of India, but it was not so much public. The public units started, actually the first one is 92, 93, when Morgan Stanley came out with Morgan Stanley Growth Fund. Way ahead of time, So that's how it started, but that also didn't fly very long. Then after that, HDFC, Reliance and Birlas, they all came out with their mutual funds. And sometime in 2003, 4, it started taking off. Once the interest rate declined, I think till then interest rates were double digit in India. Turn of the century, it became like 5, 6, 7%. Then I think the equity investing started gaining momentum, and then everybody cannot pick a stock. So this is a brilliant way of investing, where government has also done their bit of it by giving them a lot of tax concession. So well-run mutual funds, they typically give more than 3 or 4% higher than the index return. So index does 13, 14. You'll get to see most of the longer term return of well-managed funds would be more like 17, 18%, which is index will double in 5 years, but they will give you double in 4 years.
So you said only 1-2% of people should do trading, and I agree with you. What percent of people do you feel should say, when it comes to mutual funds, putting your money in an ETF or an index fund or a good large cap mutual fund, where you're betting not on an individual company, but on the growth of the entire economy, what percentage of people you feel should be doing that?
100%.
100%.
Even the speculator should do it. Whatever he earns, he should put in mutual fund.
Because if you're buying mutual funds and setting in it for a long term, you will make returns so long as the Indian... What is your risk here that the Indian economy will stop growing?
Stop growing also can make money, but first thing, it doesn't stop. It will never stop. I mean, it might be between 6 and 8. 6 is a recession and 8 is a boom. That kind of thing we have seen in the past. We're still very nascent, very young economy, very low income economy, very $2,500 per capita. Global average is 11, 12,000. So at least we should go to the average. And average also means 3 or 4 turns, which will take our life at least. So I don't see why this growth will stop. I mean, it can stop it can take a breather for some point of time. But 1 year you grow at 8%, next year it might be, on a base effect, it might be 6%, 6.5%. But I think India's story is going to be, it's like an actually elephant in the sense that it will keep walking. I mean, you'll be tired, but elephant will keep walking. That's the kind of story India is.
So if I was scribbling on a piece of paper the other day and trying to figure out like your 13.5%, how does it get achieved, right? So if the economy is growing at 6% to 8%, that's in real terms. Then you're adding inflation, which is 3 to 4%. So you're reaching 10%-ish. You add another, if that's what the economy is growing at in nominal terms, corporate earnings will be 2-3% higher. So that is what the number is, right? Your EPS is growing at 12-13%. So your stock prices should grow at that without a valuation. Is that on the basis is that your maths also?
Yeah. That's the broad calculation. But within that 13%, then you get tailwinded companies, tailwinded sectors, and then tailwinded businessmen. Somebody comes from nowhere and he does things which, I mean, you see very extraordinary performance of companies within sector. And then you get to see extraordinary performance of the sectors also. So you're talking about defense. Defense was dead 4-5 years back. Today, it is the life of the stock market. So those things keep happening. And that's where the active manager, the fund manager whom you give money, he's supposed to encash on.
So you're saying, I'm just getting the maths, the advice correct for everyone. 0 to 1% or 2% people should be trading. Don't do it. In other words, everyone should be putting money, you are saying, into large cap mutual funds or ETFs. Even if you're just starting off, you're somebody you think you're lower middle class, take some money and put it into a mutual fund. That's the advice you're giving. What percentage of people should try doing what you're doing now? Then let me try now use my brains, try and find the right, the small cap mutual funds, try and find the correct companies, try and find a way that I can get that extra return. What people should do.
So this is where the passion comes, in the sense that, do you want to become a stock picker? Because it's a full-time job. Full-time job, you have to do a lot of reading because in America particularly, books after books have been written. In fact, I mean, books on stock market is a profession in itself. So, I mean, single author has written multiple books types. So you will find your books on your subjects and keep becoming better and better. And it takes a lot of time for you to learn. And you are always learning. Even Buffett is learning now also. So there's no end to, because what is value is also changing. Say a loss-making company today could be worth $10-20 billion. Maybe 20 years back, nobody was bothered about them. So the life is changing continuously about the value itself, the concept of value. If the concept of value is changing, the price will also change. And hence you have to be always on your toes in terms of learning. Now, AI-based companies, now I have no idea what this AI is going to do. So I'll be very confused, and you might be the master of AI. So you can understand the underlying value of that company which is specializing in some services around AI. I will have no clue. I can see that you are making money, but still I don't have guts to touch that company because I don't understand what they're doing. So, so you have to be continuously reading and finding your spots. You don't have to know everything. The best thing about the market is there are 4,000 companies. You need to know your 10 companies. And rest all 3,990, let Raamdeo make money, let somebody else make money. You are making money in 10 spots. That's it.
So everyone puts money into mutual funds. That's what your advice is. If you have the passion, if you have the time, if you have the interest, if you have the ability to learn it, that's when you say, I'm going to become a stock picker and try and actually beat the markets. Because then if you can do it and you have the patience and the stomach to do it, that's when you make a lot of wealth.
Yeah,
potentially. You can also lose a lot of money.
You are riding on to that kind of possibility.
That possibility exists for
where
someone to do that.
Your compounding goes instead of 15, 17, 18, at times you might be 40%, 30, 40, 50, or maybe 100% also. For some small period, you might double, triple your money. So once the base changes, then, that allows you to, become very large. If you see the story of Rakesh Jhunjhunwala or Warren Buffett, all these guys, what they've done at their early stage, they have been very successful because they were so focused on what they're doing. They didn't bother about what the world is saying. There's good, bad, ugly, everything they did. And they they compounded their money by smart picking at a very rapid pace. Everybody's model is different, but when you're at say $1 million, to go to $1 billion is very important. But that 1000x doesn't take like 30, 40, 50 years. That should happen very quickly. Once that is done, you are reached to a base. Then when you go 10 times from, say you go 100 times from $1 billion, it is 100 billion. Okay, but if you go from 10 million to 1000 million, that is only $1 billion. So the base effect for you to make seriously large money, you need to have a base. And reaching the base has to be very quick. It cannot happen at 15%.
But this is something which you got to know what you're doing to do it.
Yeah.
Here's where the advice that you give people, I mean, like their formula, and you've come up with the formula, for example, QGLP, for example, is your formula. How do you do it? You want to, if somebody is watching this saying, nahi, mujhe karna hai. So everyone should be investing in the mutual funds. But somebody is saying, nahi, mujhe ye karna hai. I want to find the right stocks and do it. How do they do it? What's your advice?
This is a formula kind of thing we have put up in 2013-14. I was struggling to see every person who comes in the market, he's basically looking for his way of winning in the market. I cannot win your way and you cannot win my way. But everybody has to find his way of winning. Even in tennis, if you see, every Federer, Djokovic, and this new Carlos fellow, everybody is a different, they're playing all tennis. They can play across each other. But still, there is a distinct style of everybody. That is what is required. And that style has to be different to make it big. So we said our style is QGLP. So what do we look for? We look for top quality business run by top quality management. This is 90% of the wealth creation. If you have a
top quality business and top quality management. You could have a really good business, but if your management is bad or they are chores or they're siphoning of money, then your company will not go anywhere.
And other way around also. You have a useless business, but top quality management. They also cannot go very far.
Yeah.
If it is a broken car, F1 driver also cannot take it very far. Okay, so I need a Ferrari car and I need F1 driver. These two make things happen very rapidly. They cut across everything and they go forward. And if the size opportunity, India offers very longevity opportunity in most of the business because this country's own journey is maybe 100 years, 200 years. There's no stopping here. So the opportunity sizes are massive into the future and very predictable. But which are the opportunities where you want to lock in? Say banking opportunity, capital market opportunity, housing opportunity, lending opportunity, wherever, So you have to figure out which business is great business, where the money is being made.
So quality business, G stands for growth. It's growing at a fast rate for a period of time. And L is longevity. Right?
Longevity, yeah.
So it should keep on doing it for a prolonged period of time.
Valuation is taking care of the longevity growth. So it is a present value of future terminal value. So if terminal value is small, your current value will also be small. So if it is a 20-year story, longevity at 20 years henceforth, say any bank which starts successfully, it can be 10, 20 lakh crore bank. It might be today 10,000 crores or 5,000 crores. That is a potential. Now, if the management is able to realize on, the business has that potential, management, does it have that horsepower to reach that destination of top 1 to 3? The moment you are in top 1 to 3, 10 years henceforth, you'll be at least 10 lakh crore entity. Now today I buy. So top quality business, it's a good business, banking. I have to find out a management which has that energy and passion and longevity of 10, 15 years to go to top 5 banks and then buy at reasonable price.
But somebody who's listening to this and saying this all sounds good, but the problem is that even some of the best quality businesses that you have right now, you're hearing a lot of talk about how even the promoters are selling, right? There's a lot of conversation taking place these days. Promoter holding is going down. So you're saying, I'm supposed to bet in this company and the promoter, but the promoter himself is selling down. Now, is this unnecessary? You're making a mountain out of a molehill because everyone wants to diversify. They want to maybe do charity. They want to do other stuff with it. What do you make of this?
Yeah, so you have to see the intention behind selling. And I don't care who's selling, who's buying. I mean, if my analysis is right, I'm confident that I'm getting $100 stuff for 50, 60, 70. Of course, I will listen to what you're saying, that this guy has sold. Maybe I'll pick up phone and speak to their investor relations guy. I mean, is there something we are missing? Or is he selling only to buy a house or create a family office? Or he diversify. He wants to start some other business. Is that the thing? So if there is any issue in the business which I don't know, I would definitely take a pause and definitely analyze this particular factor. But I don't think this is a showstopper for me.
Is it also adding to the free float in the market? And from an economy or a stock market point of view, if promoter holdings are coming down and there's a lot more stock available in the market, is that good overall for the market?
It's very good. What will happen is that one thing, the reasonableness of price will be there. Your liquidity will be fantastic in the marketplace. Third, even foreigners who allocate based on the free float, that allocation will increase. In India, I mean, India is the only market where 50% only is a free float or 55%. 45% is, so for them it doesn't exist, and it's rightly so. It doesn't exist. So if that 45 becomes 25, will suddenly become 50% bigger market.
You mentioned foreigners. Now, one of the biggest talking points in recent times have been, everyone says that, this is 12%, 13%, 14% returns you don't get anywhere on the planet. That's one of the reasons why the Indian stock markets the valuation is higher than anywhere else in the world is because people are looking at it, they are accepting the point that you're making, saying it's an attractive market where you could see growth for 5 years, 10 years, 15 years, 20 years, however long it is. That logic is not being appreciated by every FII because a lot of the FIIs have been selling, especially last year and the year before that. How do you interpret that?
I spoke to a lot of them. See, one is that the way US market has moved. See, ultimately, mother of all the capital market is US. And US has done so well because of all this 8-10 companies from AI and all these chips.
It's not the US market itself which has grown, but yes, these 7-8 great companies.
But what scale you're talking about? One company is $4 trillion. The whole market is here $4 trillion.
Yeah.
So, like that, there are 7-8 machines like that. So the amount, first thing is their money is in dollars. So if they don't move from dollar, one headache is gone, that there is no devaluation. Second, there is a massive growth. These companies are growing at 50. NVIDIA is growing 60% on this base. Come on.
Yeah.
It's cheap actually. If they can grow it 3 years, it is very cheap, even at $4 trillion. So that
Google's
kind of
price earnings ratio is
17, 18. You imagine. And we live by Google and Microsoft and all this. So what I'm saying is this is a revolution which is on in US. And that didn't allow a lot of money to move from developed market to developing market. In developing that emerging market so-called concept, again, there's a lot of mess in emerging market. Like China had its own problem. Russia literally became disfranchised from the emerging market. So there were a lot of problems in emerging market basket. And India was always part of emerging basket. It was never a separate allocation. Because India is still 2-3%, it is about 4-5% of the global economy. So it doesn't merit a separate allocation. Like America deserves separate allocation. Like that, we don't deserve separate. Like
Japan has its own allocation. Japan has it. Europe has it.
We'll get that allocation. We'll reach there. But that will be after 7-8 years, 10 years. When we become $8-10 trillion, I have no doubts. First will be America, second will be India. Or maybe first will be America, second will be China, third will be India. We are heading towards that separate allocation. But right now, we are part of emerging market basket.
And you're saying that because the emerging market basket is only this much, you get your share. Actually, India has got a very high weightage in that emerging market basket.
Yeah, but the basket itself is not getting anything. So you might be 30% of something which is zero. So what do you get? Nothing.
The other thing there is that India's got a high weightage in the emerging markets basket. Yes, China's had a very low. I mean, Chinese stocks are actually, if you look at it, ridiculously priced, right? Our stocks are priced at 20, 23, 30 PE ratio in small cap cases. In China, it's single digits, 11, 12, 13%, and there are some very, very good companies in China. People have just not invested in China because for whatever reason, the last few years. One of the things that was happening last year was people were saying that people are taking money out of India and putting it into China. Is that something that could continue to happen?
I'm the wrong guy to say anything worthwhile because actually it's such a complex, because no FI is same. Everybody has a different mandate and they come from different color of money. Somebody's family office, somebody is a global macro, somebody is just ETF. So ETF guys, they have to allocate. They have no choice. So there is passive money, there is active money. So passive money has to get allocated every day. And that money is what is holding out here. The active money where the fund manager can take a call, whether I want to be here, I want to go to China, I want to go back to development. That's the money where we are not able to score well on a valuation parameter. So typically what they consider, I've seen a lot of macro allocators, they see, they have their own parameters for allocating to a country. And there they are finding India to be very expensive compared to their past. So if the past is say India should be more like 17, 18 P multiple, we are at 22, 23. They will say, boss, you are 2 or 3 standard deviation away from my usual thing, so you don't deserve any allocation. And to them, it doesn't really matter because they are allocating only 2, 3%, 4% in the entire scheme of things. So if somebody is managing and the scale in there in asset management, you'll go nuts when you go and see. I visited this time Washington and all. Somebody was managing 8 billion. What is the management now? 58 billion. That kind of explosion has happened. So they are managing seriously large money and there is no, but India, they have actually reduced. While they've gone 5, 6 times in the overall things, but India has remained same or little lower. So basically they are not allocating to emerging markets and particularly, then they love India. So one day this story is going to happen from foreign allocation also. When, how, what will trigger, I don't know.
You are a person who has spoken at great length about, forget about the foreigners, forget about what the FIIs are doing. Look at the strength of the Indian capital markets themselves. You've been very bullish on the capital markets. You're saying, in fact, invest in capital market stocks here in India as one of your key sectors. And that's because you have believed that there's a revolution that is taking place in India. Just talk to us a little about bit about that.
Yeah. So, this capital market, what does capital market do? It gives you risk capital. Okay. And that is like a mother's milk for any economy. And I believe India now has a flow of risk capital, which is actually second to only US. Like if US is giving 300 billion or 500 billion a year to their entrepreneurs of various sizes and shapes, we are giving maybe 200, 250 billion. So that kind
Where
of
is
a
that
risk
coming from?
This is all kinds of this thing, your mutual funds and the direct stocks. The demat accounts, as I said, I told you in the beginning, the demat accounts, which were about 40 million till 2020, has become 200 million now. Actually, we have crossed 200 million.
200 million demat accounts.
Demat accounts. So that is about 20 crore, demat accounts. Even if you take...
There'll be some duplication.
Duplication. So even if you take 60%, 40% duplication, you're talking about 120 to 125 million individual accounts. Compare this with about just 15 or 20 million in the beginning. So it is a real participation of retail. And that's what has created two things. One, it has created a floor for the market. So market is not falling. Even if economy is not doing that well, actually the pain of slowdown right now, what we are going through, is not being felt in stock market because there is a incessant flow of this, SIP money or mutual fund money, which is happening. And the fund managers, they have to buy. Their mandate is to buy. Maybe they can sit on 5-10% cash for some time, but they have to buy. And sales are continuous. So money is coming through. And still in household allocation, it is 5-6%, 7% of their entire allocation. So there is a lot more to come from the existing guys. Forget about the new guys.
You would have had an argument being made in India that there's not that... Okay, you're completely right. The allocation that was going into the Indian stock market, when you remember in the 90s and 2000, it was about 1%, 2% of the capital market. People used to all keep their money in real estate or gold. Now it's going up. But one view would be to say Indians don't have that much store of wealth, especially in financial assets. Mm-hmm. Where is this money coming from? 100 billion, 200 billion that you're talking about? That could
so, no, it is coming from household savings only. See, size of the economy has also changed. See, we are at now $4 trillion. Okay, at $4 trillion, your household savings are about 20% of that. So you're talking about $800 billion of household savings. Mm-hmm. Of that, some fraction used to come. So out of 800 billion, am I doing my numbers right? Yes, 20% of.
Okay.
So 800 billion, out of 8 billion, if you put 5%, that becomes 40%, 40 billion per year. If you put 10%, so what happens is when people are optimistic, they put more like 10%. When they're pessimistic, it might come to 3-4%. So maybe the current flow might be the more on the optimistic side, maybe $100 billion or $125 billion. And on an average, it might become smaller as we go forward. But the economy is also growing at 11-12% nominal. And in dollar terms, we are growing at about 9-9.5%. So in next 5 to 6 years, when I go to $8 trillion GDP, of that, if by just 5% I get, so I get how much? I get $400 billion per year. So we are talking about even larger amount of money coming, which is going to come year after year. So it is going to, the big thing is it's not a flow. It's not a river. It's a dam.
But once the money is in the capital markets, they
Yeah,
are
it
likely
just
to...
keeps growing. It keeps growing.
In the past, there have been crashes. And the crashes have sometimes led to a reversal of
Yes,
that.
yes.
Because if you look at the crashes,
Yeah.
everyone in India was saying, "Bhai, stock market in the Harshad Mehta days, then in other days." When they got their fingers burnt in 92, when they got their fingers burnt in 2000, when they got their fingers burnt in, other such circumstances, a lot of retail took a lot of pain. They lost a lot of money and then they stayed away for a long period of time. Is there a risk that could happen again?
Risk is always there. It's a greedy world, and we are dependent on corporate performance and many other factors. I mean, people can get scared of, like COVID. I mean, as if the whole world is coming to an end. The markets went down by 40%. From 13,000 it came down to 8,000. And straight in 30 days, the whole damn thing collapsed. And if by chance, see, I always had faith that something will come up. We'll find a way out. I mean, I didn't know that this vaccine is going to come, but I mean, humanity is not at the terminal end. That much was clear in my mind. So everything will come back. It may take 1 year, 2 years of suffering, but it will come back. We came back very fast. So markets can see why it is called risk capital, because there are a lot of risks which we cannot. If the risk can be defined, it is not a risk. Then there is only probability of the risk. But there are risks, unknowns, which nobody knows.
I think you make a very interesting point, because the COVID crash was also a very bad crash, very fast crash. People lost a lot of money very, very quickly. They lost a lot of money last year in small caps, especially people in small caps who had invested. If they were buying direct stocks, it could be down 30%, 40%.
Yeah.
You didn't see that same level of panic and that same level of despair as you saw in earlier cycles.
Yeah.
What is the is it because in the earlier cycles, first of all, there were scams and there were things like that. So people said, "Hey, kya hai?" In this case, they seem to have had the confidence that it's gone down, it'll come back up. Is it because more regulation, less scams? Is it because they're better informed now? So they understand what they're doing?
Typically, the stock market, normally it crashes. Before that, there's a massive rise. See, aap 92 dekh liye. See, first boom I saw in my life was 92 boom. I don't know whether you were around.
Yeah, I was
very much. So that
one of the first interviews I did in my career was with Harshad Mehta. I interviewed him 2 or 3 times.
Yeah, so
that headline, remember, it was a city scam. Wo mera interview tha.
So you have seen that absolutely firsthand. So index went up. You may not remember. Index went from 700 to 4,200 in 19 months. इतना बड़ा boom, इतना intense boom, मेरे ख्याल से विश्व में कहीं नहीं होगा in a major market. Okay, so that we went through. Then it crashed. It had to crash because it couldn't have sustained at 4,200. Yeah. It was 65 P multiple at that time. Okay. Then there was a lull period for 5-7 years. Then the Y2K boom started. It was a technology boom. First time computers started, all the software companies, they started going up. So again, we saw a boom where the markets went up from 2,000-3,000 to again 6,000, 7,000 and all. 7,000, 8,000. So again, it went up by 3-4x. But more importantly, the technology companies went up 100, 200, 300 times. Birth of software industry in India. That was 2000. Again, it collapsed. Because if you take anything vertically up, it is not going to sustain.
So you're saying one of the differences is that at that time, the prices did go up. There was a boom, but it was not sustainable. It was a bit artificial.
Yeah, it was artificial.
Overinflated. So it was going to crash and companies were not going to come back.
But COVID was not like that.
Media, graphics, rather than went to...
But there is a difference.
3,000 rupees came down to 7.
Yes. In COVID, it was not like that. COVID markets were very reasonable at 12,000.
Are the markets reasonable right now?
Yeah, kind of reasonable in the sense that it is 22 P multiple, so it's 10% higher than what it should be types. But who am I to say 10% higher is the right one? Should it be 20% higher? Should it be 20% discount? I don't know.
But it's not, you're not saying, it's not 400 times what it should be or 400% higher.
It's not double or something like that. It's little frothy, it is little expensive, but not out of the world. It may remain here for maybe 1 year till the earnings come. Let the earnings come by 15%, we might still be at 25,000. How does it matter? We might just pass the whole year doing nothing. That is also, there is a correction by actually market going down, or you can correct it by time pass only and the earnings come up and then your multiples go down. So what will happen, we don't know. But it is not a market where you should stay out.
So the worst things that you see in the market, the worst practices that people do, and that's when a lot of people get burnt also is, if you have the ability to last it out and stay it through, you're right. Market girega, you'll sit in it for another 2-3 years, or it'll bounce back at some point. People get burnt when they are putting in money which they can't afford to lose. It is money that was earmarked for college or for beti ki shadi hai, and you're putting the money into the stock market. Or even worse, you're borrowing money. You're leveraging yourself, you're borrowing money, you're putting it into the stock market for a quick buck. If then something goes wrong, then you're really messed. Would you agree that's the biggest mistake?
Yeah, see, in the stock market, particularly because there's a very high frequency decision making and high risk, you should not do anything which you don't understand. And that is very commonsensical. I'm telling you, it's not very technical. आपको जो समझ में नहीं आता, out of greed, don't take any steps. Like, I don't understand trading. If you come and say, sir, I've done this, no boss, have a cup of tea and go. I just can't allocate to you for trading. Because I don't believe in that. I don't understand that anybody can make money. So I will not allocate for that. But if you say, sir, I pick stocks like this is my framework. Like I am saying QGLP, somebody else comes and some other framework is there. I'll get into the detail and yes, he's trying to do something very unique. Let's do the back testing, how well you've done, and let's allocate some money. Something like, so you have to do what you understand. See, NSE and all, they have brought revolution in this market. They have created something. I don't think the world has anything like NSE in the world. But at the end of it, risk of investing is not mitigated. If anything, it is increased.
Yeah, the capital market sector itself is interesting. I'm curious, company like yours, Motilal Oswal, you've been around for a while, your origins were like sort of broking has been the mainstay of your business. Is that still the main thing that you're doing, or increasingly is it now becoming asset management or wealth management? We're hearing a lot about wealth management is the new buzzword, private equity are new buzzwords. Yeah. Which way do you see the industry moving?
Yeah. See, we are probably the largest pure capital market company, and we want to be there in every aspect of helping people make money out of, not out of lending, but non-lending when you want to allocate to the equity investing. In fact, the logo of the company is Think Equity, Think Motilal Oswal. So I want to do every aspect of equity investing, broking, institutional broking, retail broking, iBanking. I'll raise money for you. I will manage money in mutual fund format. I'll manage money in private equity. I will manage your wealth, which buys into all kinds of things. So I'll do hand holding of everybody, whosoever would like to get associated with us. So it's getting diversified. Though even today, my company is like very large in broking. Almost 60% of the profits and revenue comes from brokerage. But as we are going forward, I think the pie will change. From 100 has come to 60. After 5 years, maybe it was 25-30% broking, and rest all will become non-broking revenues.
A lot of people who get into investing, one of the mistakes that sometimes people are making is they try and become too cute. Once you say, "Mujhe investing karna hai," all your money is going into private equity and into AIFs and into exotic alternate instruments. Would you advise people that wo karne ki zarurat nahi hai? The majority of your money should be in relatively simple, straightforward, long-term mutual funds and such investments. And ye sab jo aap kar rahe ho, private equity, it should be a small portion. 10%, 20%, not more than that.
Yeah. So it will always be like that. Even in my own allocation, it will be like that. Because I manage my own money, so I can have. So you have to understand what you are investing in. So private equity will definitely give you 5% higher than what the mutual funds will give you, open-ended mutual fund. But open-ended mutual fund is T+1. Today you redeem, tomorrow evening you'll have money. Private equity cannot give you that kind. So you have to keep for a little higher return, only 5-10% of your entire corpus. If you have 100 crores, 5-10 crores definitely you can put in private equity. But 90-95% has to be direct stocks and mutual funds. So that one of the things is that when you need the money, it should be available.
Yeah.
And that liquidity is possible only through these instruments.
Looking at the sector, so your confidence in the Indian economy, you've stated it, you think it's a long-term story. Within that, now finding the places where additional growth is possible. Capital markets, I think, is one sector you've often spoken about. Quick commerce is one of them. I think energy transition you've often spoken about. Manufacturing. Have I got it right? Are these your key sectors?
Yeah. See the tailwind. See, one of the most least appreciated fact is the tailwind and headwind in the businesses. Best of the businesses. I'm talking about there is a good business, there is a bad business. I'm talking about best of the businesses. Say software is a very good business. Okay. Now
till AI kills it.
Yeah. So right now economics are good. Let's see what happens. A good business can also have very dull moment, and very dull business can also have very exciting moment. You have to figure out good business in very exciting moment. You know, when the tailwind comes for any business, say like what happened in between 95, say 97 till about even 2000 in tech business. In 23 years, the tailwind was so strong that today, I mean, you started with $1 billion export in, say, sometime in 95, 97. Today, you are exporting 200, 300 billion dollars of this thing, and you become a software kind of machine for the whole world. The whole world is dependent on you. So this is a transformation of 25 years for the world economy. So this kind of tailwind, when you ride, you mint money.
Yeah.
So there are some of the tailwinds are decadal, multi-decade opportunities are there. Like capital market, why I'm bullish on? One, of course, I see it very closely. Second, I think it is a change of character of India. We are not going to go back to, everything going to the bank deposits. Now we'll build our portfolio of non-bank deposit related, and there the best is the mutual funds and capital market instruments. So it's not 1 year, 2 year can be very stagnant also. But that doesn't mean, I mean, in 25, 30 years story, if 1 or 2 year dull moments are there, that's fine. That's where you need the patience.
But in some cases, look, quick commerce, you can understand, okay, here are the players, there are 2 or 3 players.
But they also evolve. See, right now it's a land grab. When come what may, I want to have this many stores, this much turnover. But at some point of time, after this initial phase is over, then they have to get on to making money, which will be maybe a year after or something like that. You can't be just running like mad. So everywhere and at that point of time, there'll be a break in the top line growth, but there'll be a bottom line growth.
In a sector like that, you have to pick the winner. I mean, is it a Blinkit? Is it a Zepto? Is it a, which one is it? Instagram? Do you have to select the right winner, or tailwind will take all of them forward?
Tailwind will definitely take all of them, but of them also, there'll be somebody who will be the big winner. It's because anything in digital will have winner takes it all kind of situation, whether it is partially or fully, but there'll be a sense of winner takes it all kind of thing. The guy who has 60-65% market share, he will get much better kind of profitability and even valuation. See, one is the profitability. Profit might be 20% higher, but the valuation can be 100% higher. So, the combination of these two, that gives you some crazy kind of return. But it is too early to say who will be number 1, who will be number 2. There is already a stacking order right now, but will that sustain 10 years out? That you have to see.
You think it will?
I mean, have all the players come in.
Yeah.
There are 3 of them who are active, but then 3, 4 more are trying to get in. Now they're late, but they have the thick checkbooks. So, the guys who are there, they don't have that many checkbooks. But the guys who are coming in, they're aspiring to come in late, they have the huge checkbooks. So if the opportunity size becomes a $1 trillion opportunity, $2 trillion opportunity, they don't mind blowing $5-10 billion.
One of the other sectors that you often it's been stated that you really like is energy transition. Now, energy transition is an obvious theme, but a lot of people struggle to find a winner, even not just in India, but globally. It's not that easy to find who the winners. I mean, even globally, people say, Tesla le lenge, kuch le lenge. What are the winners here?
Here, the energy sector itself offers you a lot of winning opportunities. Of course, the guys who are doing wind energy or facilitating wind energy, the components they are making, the panels and all those kind of things. But then below that, there's a whole lot of other suppliers, component suppliers, plumbers, who say like transformers, cables. I mean, you have to go one after the other. Who is being impacted positively because of this? So there's, because one is that energy demand itself is growing by 5-6% globally or some number. And on top of it, you want to transit the current base of, I don't know how many gigawatts to this thing, what do you call, wind and solar. So it's a gigantic task in terms of actually achieving. So a lot of people will make money in this, a lot of money. And there is no limit to the amount of fund flow which is there, because it is very predictable kind of return. Yeah. You put your panel for say 1,000 megawatt or whatever. Literally, they are giving you levelized traffic today for next 25 years. No inflation, nothing. Where do you get it?
And manufacturing is another. And by the way, is there any other sectors?
Yeah,
tell me about it.
There could see wherever we see the tailwind, we can talk about it today. But today is tailwind, tomorrow it can become headwind, and tomorrow new sectors will come. So you have to see where where exactly the excitement is there. Because stock market is a crazy place where, wherever the tailwind is there, it extrapolates big time and return is obscene. It can be 5, 6x, 10x in 2, 3 years, 4 years, and then it stops. So you have to, if you really want to be smart in stock picking, see, the fund manager is doing that job. So if you're buying mutual fund, you don't have to worry about all these things. That is the job which is being done by fund manager. But if you are picking a stock, then you have to be onto these things.
And my last couple of questions before I end on there are a lot of geopolitical shocks that are taking place, right? Some externally implement, some leadership is doing things as in the United States. You don't know what they're going to do one day, what they're going to do the next day. How insulated do you think India is from all of this? Is it a good, important part of the India story that a lot of it is domestic, so you're not as concerned about geopolitics as some other countries would be?
Yes, because see, the point is that my external trade, my exports is not, it is significant in the sense that we are about 20% into exports. Say if we do 800 out of 4 trillion, so clearly it's 20% of the entire game. But I also import that much. So I have bargaining power on the import side also. It's not that say like oil companies, they only export. So they have very little negotiation on the import side. They have to buy whatever the other guy, the buyer of the oil is saying. So I think if the multilateralism is not there and there's a reciprocal kind of arrangement, I think it's a very chaotic kind of system. What we have learned in the last 30, 40 years is a one system working till now. Now there is a rethinking of that particular system, multilateralism, and it's a reciprocal. So in reciprocal, what all FTAs you are able to hit, say like what we have done with UK, and government is saying that Europe will also be on the same lines. And then even US will also be more or less contour will be same, negotiating point will be same, some differences. So let's see what happens, because nothing has been put to action.
Okay.
Say like textile, you say zero duty to export to Europe, UK, Europe, America, all over. I think it's a very different kind of opportunity.
I completely agree with you.
Then market will start putting value to, the multiples will rise, earnings will come little later. So let's see what is the contour of actually executed FTAs.
Right.
Is it new wine in old bottle or old wine in new bottle, or is a earth-shaking completely new order of the global trade? And then of course winners and losers will be there in that.
Right. As I end, let me do something which I do in all these podcasts, which is some rapid fire questions just to sort of understand. One thing that you would have done differently, knowing what you know right now, you have to start the whole thing again. What would you do differently?
In my 35, 40 years? No, I would, of course I don't want to go where I was, but I think I enjoyed every moment of it.
You do the same thing?
Yes.
What is the biggest mistake that you made?
If I've enjoyed every moment of it, so I've not committed any major mistake, but we can always do things like what happened was in 2003, I listened to somebody and I stopped investing for 10 years.
Oh my God.
Okay, of my cash flow. So that put us back by, we could have been double or triple the size of the company today if I had not done that.
Right. One sector that you still think is very undervalued in India?
Undervalued I don't think there is anything like that. Yeah.
Okay. The first stock that you ever bought, did it become a multi-bagger? Was it a mistake? The first
No. In fact, that actually encouraged me. I bought a company called Semi India, which is even listed now. That time it was $15. It was a British company, foundation laying company. And that in 2 years time, it became $45-50. So maybe I must have bought 500 shares or something. And that went 3-4x. That taught me, boss.
Market crashes. Are there things to worry about, or are they the biggest opportunity you'll get?
Yeah. Biggest opportunity if you are sitting on cash.
Yeah.
Okay. Otherwise, it's a painful experience. A person like me who is 100% invested, even if I know that it is going to imminently crash, one of the things is that I never do timing. So I never try to sit on cash and let the crash happen and then I'll buy. I don't think I have that guts nor insights like that.
Okay. Worst investing advice you still hear in 2025? The worst investing advice.
Worst investing advice. Anybody trying to see, making 15% is much easier than anybody thinks in India. In India, I'm saying. But making 25% compounded is far more difficult than anybody thinks. So I don't think a lot of people are getting lured, these family offices, young kids, to, even surpass 25%. So
And that's where they will get burned.
Yes, not get burnt. I think they'll realize as they go forward that it's not that easy.
One thing that you admire about young people getting into the market right now?
Yes, one is that they're technologically very savvy. I struggle with, I still trying to understand AI. For them, it's like they understand. So earlier, my son whenever I used to ask question, he will go and look at Google and give me an answer. I was not that. Now I have come up to Google. Now they're going to the AI. So that's the gap. So these guys, they have a tremendous advantage. We learned very slowly by reading one book, two books. Vikram, we had no books in India in 87. You might be knowing how thin it was. The books started flowing in 94, 95. Before that, even books that were not available in libraries also, it was not there. So now they have opportunity not only of the books, podcasts, these kind of conversations, and then they can have very select screening.
They can actually be educated.
Yes.
So your last word of advice, somebody watching this, especially a young person, 20 years, what would you tell that person? How much of their money should be in equity at this stage?
That is absolutely their call, but don't think small. India is a country, now new billion is a trillion. Think about that. Have that ambition to become a trillionaire, not a billionaire. You will make it. Somebody from India will make it. You'll be the first.
There's an India story taking place. You can be part of the India story. Well, you can start by watching the India Story podcast, of course. Raamdeo Agrawal, such a pleasure talking to you.
Thank you. Watch me talk to Vikram Chandra on India Story podcast.